Hello everybody, I'm Sam, this is Shanelle,
Hi,
and
guys.
today what we're going to do is discuss the top 5 questions on Google about bridging finance. So, should we just get straight into it?
Let's get straight into it.
Right, question number 1 on Google regarding bridging finance is a bridging loan cheaper than a mortgage?
Wow.
This is, I was quite amazed that this was going to be the number 1 question.
Number 1. Yeah, because everyone wants everything cheap.
Exactly. I think a lot of the perception a lot of the time is that it is more expensive.
Yeah.
If we're looking at like taking it over a 12-month period,
Yeah.
it is, I think, when you just compare like apples with apples.
Yeah.
But
Numbers, yeah. The numbers just, with the way they stack, yeah.
exactly. But with a lot of our clients, they refinance before a 12-month period.
Literally, yeah.
So what sort of time frame do you think on average your clients, so we're doing either a BRR or like an HMO conversion, you're using a bridge to purchase, how long on average do you reckon your clients are taking and then we're refinancing them out, how many months?
It's difficult, isn't it? Because when you look at, when you have a conversation with a client and you discuss what their aims and objectives are for the next, 5 years, are they trying to get in and out of deals quickly? Are they buying properties that don't need a significant amount of work doing to them, which means that they are going to be in and out within 6 months? But then when you compare some of the other clients who are doing HMO conversions where they're doing the full whack and they're spending 150k, are they going to get in and out within 6 months? Probably not. So an example of comparing the cost of what it is at the moment, I did this exact thing with a client last month or the month before.
I think I remember you telling me about this.
Yeah, and if you're looking at how much product fees are at the moment with mortgages, if you compare that and you put the exact figures on a 6-month process, because that's what the client was looking to do, was to get in and get out within 6 months. I was going, okay, so what is the product fee that you're going to have to pay? And compare that to how it looked like with the bridging, it did actually work out cheaper to bridge.
It is. This is
yeah.
it. And if we're to explain, I guess, to those that maybe aren't following exactly what we're talking about, is the interest rate that you're paying for a mortgage is annual.
Yeah.
So to work out like the APR, to make a comparison, we take that interest rate that we're paying annually, which at the moment, I think the average, even if we take into account residential rates, which are obviously lower than buy-to-lets, etc., I think the average right now is like 5.39, something along those lines.
Yeah.
Some lenders are charging like 2, 3, 4, 5% as fees.
Yeah.
Chuck that on top. That's your annual cost, basically. Yeah. Then we compare that to a bridge. Now, you might be paying 1% a month on a bridge. 12%, that's obviously higher than 5.39. You're paying 2% fee on average. So, that's 14%. Straight away, you're going, well, hang on a second.
Yeah.
But you're going to have to keep that money on that mortgage regardless. But if we actually pay in 6 months, you're still paying it that 2% fee. But this is a 1% per month bridge, by the way.
Yeah.
This might be cheaper. So suddenly it goes from 14% to actually to 8%. Now, if you're paying 5.39 and you're paying a 3% fee, that's 8.39.
Plus the early repayment charge.
Plus the early repayment charge.
Yeah.
So is the answer to this question, is a bridging loan cheaper than a mortgage? Actually, yes.
Yeah, at the moment.
I
would say, yeah. If you want to
potentially.
for clients who want to get in and out of obviously it's deal dependent, but if you want to get in and out of a deal within 6 months, you're going to need to put it on a mortgage that's going to have early repayment charges. If you don't want early repayment charges, then the interest rate goes up because the flexibility, they want to charge you a little bit more for that. But yeah, at the moment, that's what I'm seeing as a generalisation.
I bet you weren't expecting that.
Yeah.
And I remember us having that conversation as well, and you going through it with me, and I was like, yeah. And I knew there was a reason I employed you. So there we go. Is a bridging loan cheaper than is a bridging loan cheaper than a mortgage? Yes, in certain instances it is. But you have to actually figure out the figures, time frames, term length, early repayment charges, all these things taken into account. Potentially a bridging loan might be cheaper.
But this is why you work with a broker, isn't it? Because you go into a broker with your aims and objectives, and our job is to work out, okay, where are you right now, and where do you want to get to in 5 years' time? And if that means you're doing quick flips that you're doing every 6 months, then yeah, that's how we would advise you. So yeah, it's key there to have a chat with a mortgage broker to understand your circumstances as well, because that
100%.
obviously affects the rates,
Yeah.
how much you're paying, and all those different fees as well.
Exactly. And links to organised calls with both myself and Shanelle will be in the description for this video, or if you're listening in on the podcast, it'll be in the show notes. Cool. So, question number 2. Are you ready, Shanelle?
Yep.
Do I need a deposit for a bridge? Now, I don't know about you, but I reckon this is the number 1 question that I get asked.
Well, it was only recently we were on a call with a client. They said, "Oh, I want to buy this house at auction." Cool. How much cash have you got available? "Oh, I haven't got any cash. I saw online you can get a 100% bridge." Yeah, that might be true, but again,
So
circumstances.
talk us through them. So, getting a 100% bridge is. This is the terminology that is used, but it's misleading, isn't it? What does a 100% bridge mean?
Well, getting 100% borrowing on a property will completely depend on how you're acquiring the property, essentially. Are you buying it below market value? Because then we can utilise open market value lenders that will actually lend to you based on what the property is worth and not what you're buying it for. So if you're getting a significant discount on the property and you're buying it at X amount, then yeah, you can borrow 75% of what it's worth, which sometimes means that you're not putting a deposit down. But then you've also got to consider that you've got to get into the deal. So soft costs such as solicitor fees, valuations, our fees, everything, it all adds up. And so you do have to have some money in your back pocket, even if you are getting 100% borrowing. So
exactly.
That's...
And in addition to that, a lot of the time when lenders are talking about 100% bridging, what they're actually saying is 100% of the value of the property you're purchasing. So what we're talking about there is actually available equity. We're not getting 100% of the available equity. So what that will mean is either A, exactly what you just said, looking at open market value, is the discount you're getting significant enough for you to actually borrow 100% of the purchase price?
Yeah.
Or sometimes it's using equity in another property. So a lot of the time you read the small print on those things and it says you know, subject to needing other property. That even happened on a mortgage. Back in the day, Barclays used to do their 100% guarantor based first time buyer mortgage thing, and in the small print it was like, and we will be taking a second charge over your family's home. So you're still not getting 100%.
Yeah, that's it.
So yeah, it's differentiating between 100% of the purchase price versus 100% of the equity. And I think a lot of people get that confused. They think, I'm going to buy that property for 500 grand and I'm going to get 500 grand and the only charge will be on that property. Now, unless you're buying that property probably for about 700 grand, the chance of you covering it is absolutely pretty much zero. And exactly what you've said as well, there are other soft costs that are involved in that. And a sort of a follow on from this is actually the deal itself and getting out of the deal, like you sort of half mentioned, which is, if you're not putting any skin in the game, can you actually create enough equity that when you refinance, you can actually pay back the bridge? I say this all the time to clients. They're like, oh, you know, I'm going to buy this property, 500 grand. I am going to, I'm going to get a bridge to purchase it, and then I'm going to get an investor to cover the cost of the deposit. They're going to cover the cost of the fees, the legals, your fee, the planning consultant, whatever, the cost to do the work. And then you're like, okay, cool. So you're borrowing 100% of absolutely everything. And don't forget, you don't just have to pay that back. You've got to pay that back plus interest. So you're paying back the bridge plus interest, and you also got to pay the investor interest as well. Now, if the investor, and this is one of the issues that we have quite a lot, but if the investor is then going to take a charge over the property as well, when we refinance, we have to pay back everyone. So if a bridging lender cannot see that is viable, they won't even lend you the bridge in the first place.
That's it. And we wouldn't even dream of approaching bridging lenders without considering what the exit will be.
Exactly.
You've got two options. You're either going to sell the property or you're refinancing it, pretty much. That's really
that's 98% of the time. That's
the two main options that you've got. And if we can't, and we're brokers, I mean, we calculate what is this going to look like in 12 months' time when you want to pay it back. Is it feasible? I mean, realistically, if you're going to be a property investor and you're leveraging 100% of a deal, it's risky business.
It is risky, and I think back in the day, and I always said, I've got no real issue. I mean, I did my first ever flip that I did not put I didn't put 1 penny of my own money into it.
Yeah.
And we made a profit. And in fairness, it was in a crap market. It was in 2010,
Okay.
11.
Yeah.
So wasn't the best of markets either. And it worked. But I wouldn't say we were lucky. I just think it all worked out quite well. We bought really well, etc. But the reality of it is we were in and out in about 9 months. But what would have happened if we just couldn't find a buyer? Yeah. And at the moment, one of the issues is on a flip, if you're borrowing absolutely everything, flips are profit-making strategies. Yeah. BRR is a profit-making strategy, but it's actually a portfolio-building strategy. So they are very, very different. So you are leaving money in a deal for BRR, you're taking money out of the deal with flips. Yeah. But a flip is only going to work if the sales market is strong enough for you to be able to sell the property. Otherwise, you need a plan B, which is obviously going to be refinance. Yeah. So this is what we obviously do, is we'll look at what the plan A is, if it's to flip, if it's to sell the property, whatever that might be. But even lenders sometimes will say to us, can you just check to see if there's a standard option for a plan B of refinance? And then we have to look at, right, what's it going to be valued at? Take a bit of a haircut because we know what valuers are like at the moment. What's 75% of that going to be? What's the rental income likely to be? Is it possible on a standard rental income to get 75%? We've got to take all these things into account. Yeah, and the reality is, if you're borrowing every single penny, the chances of you in this market being able to do that is zero. Go back pre-credit crunch. To be honest, go back pre-sort of Brexit times, where we had that nice little bit between credit crunch ending and Brexit sort of beginning and the market becoming a bit turbulent again. We had a really nice property market where you could do money in, money out deals, and this is what all the gurus now sort of preach about, because that's where they all made their money. Yeah, exactly. But they're talking about that market, not this market.
Yeah, it's tough, and I think it's about mitigating your own risk as an investor, and that's going to differentiate you between an investor that's going to do well and go the long run than this is going to be your first and only deal. Because that's the thing, when you're approaching bridging lenders, you've got to make the deal make sense to them, and if it doesn't make sense to them, then it's not worth doing, in my opinion. Like bridging lenders, they know what they're talking about. They're able to understand the risk associated to getting in and out of deals, and if they don't see it's viable, then it's good to take their advice on.
But also the what lenders and I've for the greatest number of years I've been doing this, lenders actually say to me as well, we want to see that clients have some skin in the game. Yeah. Because it actually spreads the risk. Yeah. Because otherwise, I mean, look, with personal guarantees and all this kind of stuff nowadays, the client is taking a risk, but if actually they don't have any assets in the background, their personal guarantee is pretty much worth nothing. And therefore the lender's actually taking all the risk. Yeah. So lenders just want to see, it's not because they can't necessarily do the deal sometimes, but it's because they just want to see that the client is doing the same and putting putting their head on the chopping block a little bit as well.
That's it. Yeah.
And there's nothing wrong with that. One thing on that, just talking about putting money in and all that kind of stuff, one of the big differentiators that I find between really good investors and the ones that I think will struggle a little bit is a lot of my clients have cash flow. They've got something that can generate funds for them. And I always talk about this with my clients, is if you can be in a position where you've got something that cash flows, whether it be a really good job, a good business, or a portfolio, having the ability to put money, take lumps of money and put them into your flip business or your portfolio building business, which I tend to see those as, some people will have to keep them separate, but sometimes I see it almost as a bit linear. Yeah. Like I see some of my best clients, I talk about this like 3-pillar strategy all the time. Cash flow at the beginning, generate the money, use that to develop / flip, grow the money, use the profits to build the portfolio. Yeah,
keep the assets, and it's having that behind you will give you that safety net. I mean, I've seen developers before where they've said, if we didn't have that cash flowing portfolio behind us when we did this development, we'd be bankrupt. And so it's a frightening thing to hear, isn't it? And when you do get into the bigger deals and doing the bigger projects, you have got to have that behind you, because one thing going wrong can can ruin the next 10, 15 years of your life, you know.
Massively, and you don't just go back to square one, you go
beyond
square one.
Yeah.
You know, you're at -7. And that's hard. You know, unfortunately, there have been a few instances in the last sort of year where we've been working with some clients that have come under difficult circumstances, some through their own manufacture, to be honest. And they are now in a worse situation than when they started. And so you've got to be wary of that. And putting your own cash into deals is a really good way of actually mitigating your risk. Because you are reducing the amount of money that you have to pay back to people. Therefore, if something does go wrong, you've got that buffer, haven't you? And you're losing your own money rather than somebody else's. And I think that's important.
And I think putting your own money in as well creates a bit more. What's the word I'm looking for? It puts more onus on you as the investor to actually do due diligence properly. Like you said, you've got skin in the game. You don't want this to go wrong because it's your money you're losing. So that's going to make you do that extra bit of research that maybe you wouldn't have done if you were just borrowing someone else's money.
This is like I think a business rule in general. If you're flush with cash, you think less about spending it. So you know you might use the example of somebody that's putting loads of money into a marketing budget. That marketing team is not necessarily going to be. They're just going to be chucking money at everything. Rather than being really kind of squeaky on what's going to give us the greatest returns. You might have like a company, like a venture capitalist company that buys other companies. If you've got loads of money, you just go buy everything. Rather than if you haven't got a lot, you go, right, I've got 10 opportunities here, I need to pick the one.
Make it work.
You know, and that's what you do. You're absolutely right. Absolutely right. So basically, that was we big old margin there. Do I need a deposit for a bridge? Yes and no, I guess. You need, it might not be money, but you definitely need equity at the very least as a deposit.
I mean, it covers everything that we've probably spoken about for the past 5 minutes, isn't it? It's like you can. That's the thing. You can do it with little money, but you go a lot further when you have got it.
Absolutely. Absolutely. Right. Question number 3, and again, these questions are great because I do actually get these a lot. I'm sure you do too. Do you pay monthly on a bridging loan? So there you go.
Do you pay monthly on a bridging loan?
You can.
You can.
You can. I think what a lot of people think with the bridging loan is that it's easy to pay monthly. So very, very quickly, there's essentially 3 ways of paying interest on a bridging loan. So we've got retained, which is most lenders' preference. So obviously that will be taking the gross loan, which might be 75%, and then it might be a 12-month term, and then they retain or deduct the interest. Or the opposite side of that is we do rolled interest, which is actually essentially the other way around, where we start with a lower loan amount, and then we add on the interest of the loan each month until we reach a ceiling. And then of course the last one is what we call serviced interest, which is when you pay it monthly. Now, lots of people, if you do the serviced interest, then the net loan that you're getting will be higher because obviously you're not having to pay the interest as part of upfront and as part of the loan. But of course we know that there's issues with that. Now, when we've got a buy-to-let mortgage, servicing the debt, i.e. paying the interest-only payments per month, lenders can look at that and go, well, we've got a rental stress test that says that you're going to get enough money in each month to cover your payments through the rent. With bridging, a lot of the time these are refurbishment projects, stuff like that. We're not getting rent. We're not getting rent. So I find, and I don't know if you know any deviation to this, but the rule of thumb for me is if you can highlight to the lender that over the last 3 months you've got a rolling surplus equal to or more than what the monthly payment would be to pay the interest payment, lenders are generally okay with it. I don't know if you see any kind of variations of that. That's it.
It's all about your what you've got left over every month once you've been paid, and it's back to that cash flow situation, isn't it? Making sure that, like you said, the 3 pillars. If you've got cash flow, then that will allow you to take a bridging loan and service the debt rather than having it retained, because although the lenders prefer to retain the interest because they got their money straight away, they've taken their interest straight away, but for you as the investor, that may mean that you've added an extra 3 to 6 months onto your bridge just as a safety net in case anything went wrong, but you're paying that interest for 6 months potentially that you don't need to. Yeah, albeit you'll get it back at the end if you do repay that bridge early. But by servicing it, you're paying it every month, and once you're finished with the bridge, that's the end. And yeah, if you've got cash flow, then I mean it's the easy way to go, isn't it?
Exactly. I mean, but then I guess the flip side of that is, if you have got cash flow, then potentially you've got some cash that you can put down a higher deposit.
Yeah.
So you can do the retained interest, which means then that you don't have the concern of having the monthly payments to be made.
Yeah.
And so you're kind of not having to worry about that if you've got extra money stashed away.
Yeah.
So if you do need to use that cash for increasing cost of building materials or something like that,
yeah,
then it can be used. I think it comes back to what we were saying previously, that generally if you can put more cash into a deal, it's better.
Always. You pay less interest. I mean, you're less leveraged, you're not stressed, thinking, am I going to be able to pay this back? Yeah. It just, if you want to do things and be able to sleep sleep easy, knowing that, you've got that safety net, then
Another thing that a lot of bridging lenders now do is they can do like a split interest. So we could do 6 months on retained, so we could retain 6 months with the agreement that we will start paying the interest per month after 6 months. Now, what a lot of lenders do with that is that they will take into account the fact that you might be getting rental income by that point. So a lot of the time, and this again comes back to, and it always sounds like I'm trying to like big up, or always use a broker. I mean, of course, always use a broker if you can, but a lot of lenders actually will make an assumption on that and won't necessarily, because it's after 6 months, they might not do the level of due diligence that is probably necessary to ensure that it is feasible for you to do that.
Yeah.
I've certainly seen that on a few deals recently. So having that broker there to give the client the reassurance that they don't even know that they probably need, that actually it will be feasible to do that at some point. Right, this is what you will start paying. You're going to be paying £1,500 a month in interest as of month 6/7.
Yeah.
Well, okay, where's that coming from? Well, your rent's going to be £1,600. So you haven't got a lot to manoeuvre there, but it's only short term, and you will have that money there, and you will get it rented out by that point. Okay, happy days.
Well, that's it. I've started using that technique with clients that I can see there's plenty of surplus, monthly funds that they've got every month, and I say, well, we could retain it for the full term, but it may save you a little bit. You put less down at the start if needs be, by obviously adding the serviced element of the loan. Because by then you will have got the tenants in there. So
it's also, I think it gives the comfort as well. So if we do it a split 6 and 6 months, we'll say, well, I mean, for me on average, my clients I probably would say get out between month 5 and 8.
Yeah.
So if we are aiming to get it done by month 6, for example, as you mentioned a couple of examples previously, well, we're never going to get to that point where we need to service it there anyway. But by having that term continue on till month 12, it's going to cost us less to start having to pay a couple of months worth of interest than it is to fall into default interest and pay extra fees and all that sort of stuff. So 100%. I think it's a way of being a bit creative, and this is why I talk about bridging finance all the time. I truly believe that as a property investor, if you understand not only how bridging finance works, but how you can use it and all the different ways in which you can use it, it makes you an infinitely better property investor. Yeah,
it's utilising it as a tool and not just seeing it as an expensive shovel to dig gold with.
Exactly.
But yeah, like you said, I've started noticing it because clients, they want 6 months bridge when they've got a 4-month refurb, and I'm like, I don't feel comfortable putting you on a 6-month bridge when you've got a 4-month refurb, because I want to allow at least 3 months to refinance, and then you want a safety net of in case your refurb runs over. So like every time I've put a client on a 6-month bridge, they've run over, and it was only meant to be an 8-week refurb. So it's like, okay, I've learned quite quickly that a 9-month bridge with 3 months serviced interest works out a lot better for the client, because then they are still only paying 6 months retained interest. And if you go over, then it's down to you to start paying it monthly. Obviously, we check that they can afford that, but then the client gets what they want, and I get what I want, because then it's their safety net, because we're here to advise them and look after them, So.
Absolutely. No, very good advice. I think we covered that off. Yeah. Right, question number 4. How long does it take to arrange a bridging loan? Now, I mean, this, if this is literally the differentiator between the shortest way and the longest way.
Yeah.
There's a big difference, and it depends.
Yeah.
I think it depends on a lot of factors.
Yeah.
What's the quickest bridge you've done recently?
Oh God.
Bearing in mind the market's pretty rubbish at the moment.
Yeah, and it again, it depends on the lender as well. I say it depends on the lender. It depends on the client solicitor as well. It's very many variables. Sorry, should I say?
I think it's down to risk a lot of the time.
Yeah.
So if you've got, I've got a client at the moment where we have got a really tight deadline. Now, when you have got a tight deadline, you've got to weigh up: is it worth the risk of paying out some fees for something that might not actually end up going ahead? I think that's what it's all about. Because with a bridging application, the way I kind of describe it to my clients is: if you're doing a mortgage application, it's linear. We do our decision in principle, we do our full mortgage application, we do our underwriting, we do our valuation, we get our offer, and then we do our legals.
Yeah.
With a bridge, you can overlap that to the point where you can do all of that at the same time. Of course, we do have the initial bit at the beginning where we're just getting the terms together, but usually the application process is quite straightforward. So we can do the application process, get quotes for valuation and legals, pay said quotes for valuation and legals, get the underwriting started, get the valuations booked in, and then instruct legals as well. So we're doing all three of those things running side by side. Now, of course, if something comes up in the valuation, or something comes up in legals, something comes up in underwriting that causes the entire thing to fall apart, you ain't going to be getting those fees back. So that's where the risk is. But if you do that, then, and you want to take that risk, then actually you think of how long each of those things take. So underwriting generally a couple of days. So that'll be out of the way nice and quickly. Legals, worst case scenario, we're probably talking 4 weeks, because that's how long the longest search will take. That's the local authority search, takes 30 days generally. But we can take out an indemnity insurance policy against that. So that might cost you 200 or 300 quid, which means that we don't need that completed before completion or before drawdown of the funds. We can get that to the lender afterwards. So that means you don't need to do that. So legals could, the quickest I've seen legals take is a week. And then valuation, say we instruct it day 1, gets booked in on day 3, and report is back on day 6, then we start moving the money around. So if we're doing that, we're talking about a week and a half. Like all these like people saying, oh, I've done these 2-day, 3-day, 4-day bridges. Generally speaking, that's only when something's gone wrong before, and a bridging lender's had to step in. We don't need a valuation, or we can do an online valuation, or half the legals has been done. If we are talking about starting from scratch, I think a week and a half, 2 weeks is pretty much the quickest you're going to turn it around.
Yeah, I agree. To be honest, I've not been in a position where I've needed to do that for a client. I've not been that. I think the quickest I've needed to arrange a bridge for a client is the auction. So 28 days, 30 days.
And the thing is, if you do everything that we've just said, I tend to do, and I think you probably do the same, is we've usually got 20 working days with an auction. So I tend to work on let's all work to 15 working days, so 3 weeks. Because then it gives us a 5-day buffer if something goes wrong, and a 5-day buffer to move the money around. Because the amazing thing with bridging is we can do all this stuff, and then this is one of the things that drives me nuts. Is it can take 5 days to move the money around, and I'm like, hang on a second. These bridging lenders, they put all this time and effort into making sure their underwriting is quick and their legals are quick, and they've got all these things and processes in place to speed up everything. But then they haven't put the time and effort in just putting the normal functionality in to be able to move money quickly. It takes 5 days. I had a situation recently, it took 6 days to move the money. It was stuck with the lender's solicitor for like a day. I'm like, why? Why? And it's literally because, we were busy, we didn't see that it was in. Like just human error.
Manual,
The manual processes. And this is, where, not wanting to deviate too much, but you think about things like blockchain technology and cryptocurrencies and all that kind of stuff, where money can literally be in one place 1 second, another place another second. Having the capabilities of doing that, it might mean that you transfer pounds into a cryptocurrency, it gets transferred, and then it gets transferred again into pounds again. But that'd still be a quicker process. So that's another technology that hopefully lenders might be able to implement at some point. And by doing that as well, and doing things like smart contracts and all that sort of stuff, obviously we're going off on a bit of a tangent there, but those things in place mean that actually the legals becomes quicker in terms of the moving the money through the legal advisors. And it doesn't necessarily need, and I've just gone through that process. So you convert pounds to crypto gets moved, crypto gets back into pounds and then you have to repeat that process, it takes less time to actually do that than it takes me to describe what it is, so or how it's done. So actually that's instantaneous. So then it's there, and because blockchain is so safe, less checks will be needed from each legal advisor. So it could probably be moved from lender to vendor,
lender to vendor
in seconds.
Yeah. But it's about moving all of that technology forward, isn't it? And having everything to support that. Because I saw a property investor was posting that they were in their solicitor's office, and it's like, surely there's a quicker way. There's something that can be done about the legal process. I was
speaking to, and this is all that does come part of this question, which is how long does it take to to actually apply for a bridging loan. But where was I talking to recently? A lender still wanted originals of a signed document.
Yeah.
I'm like, why? Like, we get our clients to sign our terms of business digitally.
Yeah.
So many things are done digitally, and actually in certain instances there is evidence to suggest that digital signatures are actually more safe than a wet signature, because anyone
can
could have
do
done
a wet signature, but you can
and
follow IP addresses and things like that when you get
so it's actually safer to do a digital signature. And lenders, I find that bridging lenders, some of them are amazing and some of them are so behind on the technology. And it's just about educating these lenders. I mean, it will come into place at some point in the future, but I guess this all comes back to not only just this question, but when we speak to our clients a lot of the time, and we're saying to them, like, I use the terminology, what's the drop dead date? What's the date that if we do not hit that, it's done? And then we have to use our knowledge of doing regular bridging loans, and knowing which lenders are doing what and what their process is. And it's not just how quickly they're doing their underwriting, it's what access do they have to surveyors that can do it quickly? Who's doing their legals? Are they able to do joint representation? How quickly can they move the money? Do they need wet signatures on this, and this? We have to know all that stuff, and that all fits into how quickly the overall transaction can take place. And I think we're very lucky because I think we're quite well regarded by bridging lenders. We do kind of have our pick of who we use, and we will tend to favour those that have this technology in place, because it's not just about the cost. We spoke earlier about cost, but it's not just about the cost. I talk about the bridging triangle. Speed, cost, flexibility. And I always say, if speed and flexibility are not your priority, that only then do we go on the cheapest option.
Exactly.
But most people need the flexibility of a high loan to value, or the ability to work at speed if you're at auction, in which case that is your priority. And generally speaking, I find that 9 times out of 10, cost is the least priority. Speed and flexibility in some way, shape or form. We talk about open market value bridging. Not all lenders do open market value bridging.
No.
We talk about refurbishment bridges. Not all lenders will do refurbishment bridges. So if that's the case, then you need a flexible lender, and if you need them to then also work at speed, cost is tertiary to those two.
And that's it. And when you go into these niche lenders and you've got niche requirements, sometimes you have got to take the hit on the fees, or take a hit on how quick it's going to take. So sometimes there is a little bit of compromise, but we try our best to fit all three and make our clients happy. But sometimes there has got to be a bit of compromise.
Indeed. Cool. So how long does it take to arrange a bridging loan? Well, your guess is as good as ours, but generally short term. If we're starting from scratch, nothing been done already, 1.5 to 2 weeks. But if it goes wrong, or we've got bad solicitors, it goes into the months sometimes.
Exactly.
Cool. Right, fifth and final question. What are the alternatives to bridging finance? And I think I would put this into 2 categories. What I think we're talking about here is a standard bridging loan. What's the alternative to a standard bridging loan? 75%, or actually standard is probably a 70% bridge. So we're looking at different products in terms of non-bridging loans, and then we're also looking at variations on bridging. I think so. Going through the non-bridging ones, I would say we've got using cash, obviously.
Yeah.
And actually, I speak to my clients quite a lot about cash, and I say, because I've got loads of clients that buy with cash, and it's because borrowing money on BRR, conversions, whatever it might be, they're just a facilitator to allow you to build your portfolio or do what you want to do quicker.
Yeah.
So borrowing money just means that you can make your money go further. You don't need to save as much to get the deal done, or you could end up doing multiple deals at the same time because you've got enough cash to buy this project.
Yeah.
But if you borrow half the money, you can put the other half into another project, and you can run them side by side and do more.
That's it. I always say this to my clients. You can choose simple figures, but say you've got 100% of the money to buy a house cash. Well, if you used bridging finance and it's a 25% deposit, obviously you've got fees and things like that, but you could buy 4 of those projects with the same money, and then that 4 properties will add to your portfolio, and in a year's time, with the capital appreciation on those 4 properties, it just
and the cash flow they're going to generate as well.
Well, it just snowballs then from there. So you've gone from 1 to 4 in exactly the same time that you could have taken to do one deal. And it's really good. I always say, if you want to buy your first deal cash, dip your toe in and get a feel of, because you may not even enjoy doing it. You may not like property investing, and so if you want to do it and put all of your money into it, know that it's safe. Well, it's safe, but know that you're not over leveraging and risking. Then do cash. But like you said, if you're trying to grow aggressively, then split that money into multiple projects.
Yeah,
for sure.
I totally agree, and I think that this also, just not going too far down this rabbit hole because it sort of deviates away from this question, but it's not over leveraging as well. So I think using cash and using it well, just you don't have to always leverage to the highest amount. You don't have to go to 70-75%. You could do a 50% bridge, put 50% of the money in yourself. That's and that you're still it's a nice halfway house. Then you're de-risking it, you're reducing the cost of your funds massively, but you're not putting all your eggs in one basket. And I think that's always a good sort of like another
halfway in between. You can either go full hog and get the 4 properties, or you can maybe even do 2 at a time, or you can do 1. It all depends on back to what your end goal is, where you want to be in a couple of years' time, and work back from there.
Obviously, we've also got the other alternative, which is using an investor. We've both got clients that use investors all the time. Sometimes we'll use a combination of that and bridging. Sometimes we'll use just an investor. I think the key with investors is I think it's trendy. It's cool to use an investor, isn't it? You see it on Instagram. How to use investors. Well, great, happy days, great. But everyone just assumes it's better to use an investor than a bridging lender. I think there's 2 reasons why sometimes it's better to use a bridge. The first is that genuinely sometimes it's cheaper. So exactly what we were talking about before. A lot of investors will look at fixed returns. So they will look at, you're paying me 10% regardless. Now, you might be paying 1% on a bridge, but then, and your 2% fee, 14% for you per year. So then you're looking, well, actually that's the same. Well, if you pay it off in 6 months, then actually you're only paying 8% versus 10%. You're saving 2%. Because you're paying that investor back 10% regardless. So it's always important to look at that. But also, in fact, there's 3 ways. Let's add in another one into there, which I'll chuck it into the middle, which is you've got to do the due diligence on the origin of the funds. Sometimes that's going to be quite difficult. You've got to take a lot of responsibility for where that money has come from, because if that money is found to have been from an illegal source, that transaction has gone through, you're complicit. The lender's also complicit if they haven't done enough due diligence. But you're, especially if you're buying cash with the investor's money, and you're not using a bridging lender, because obviously they would ask to check it. But if you're doing it cash, and then that money is found to have come from an illegal source, you're complicit in that illegal activity. And naivety is not going to stand up in court. You are charged with doing that due diligence. So that is extra work that you need to do. And the last one is actually professional relationship. A bridging lender is just an organisation. They're providing a product, a service. When you get an investor involved, especially as a family member, a friend, potential business partner, all this kind of stuff, it's all human beings, and that can sometimes make it more difficult as well.
I agree. There's emotion attached. I love the fact that when you use a bridging lender, it's an extra pair of eyes. they do bridging, like they see property deals every single day. So if they're looking at your deal and thinking, oh, it's tight, maybe we might de-risk and give you, 70% loan to value rather than 75. It's a good indication of how good your deal is.
Totally.
And I always say this to clients, it's like, if this lender likes your deal, it's a good deal. So yeah, I think it's another pair of eyes.
Exactly, and why wouldn't you want that,
Yeah.
particularly? So okay, so that's kind of like your non-bridging alternatives. Now, I mean, to be honest, there's probably infinite uses for bridging in terms of alternatives to the standard, but we've already spoken about a couple, but I suppose we can reel a few off. We've got open market value bridging.
Yes.
We've got refurbishment bridges.
Yes.
We've got development finance. Anything else you can think of?
I mean, you could do an exchange delayed completion, which essentially is open market value, isn't it? Yeah. But yeah, there's so many different products you can use.
Like stretch bridging, where we go to 80% loan to value.
Yeah.
So yeah.
But yeah, there's loads.
There's loads of different ways. So I suppose as an alternative to the standard, where we might be looking at 70-75% of the purchase price. So that's like your standard bridge. That's where you're going to go to like the precises of this world.
Yeah.
Your real vanilla lenders. They're going to offer great rates, but Jesus Christ, they're going to make you work for it. So then you've got, like I said, the alternatives. You've got your open market value bridge. We've already sort of touched upon that, where you're looking at basing the loan on the open market value, not the purchase price. If the purchase price is lower, so obviously that gives you a higher loan to purchase price, which is really useful.
Yeah.
Refurbishment bridges, taking it to 85% loan to value. That extra 10% on the standard is meant to be a contribution towards the works.
Yeah.
You mentioned delayed completions, where we can look at open market value bridging at completion rather than at the point of purchase or the point of application or the point of valuation, which is really useful.
Revolving credit line.
Revolving credit line, yeah, that's another really, really good one. Yeah.
So if you've got an unencumbered property or an unencumbered portfolio, you can leverage that, and they can basically give you a pot of funds. It's like, someone said it's like a credit card or an overdraft. It's basically the money is there for you to use, and then once you've done your deal, maybe you buy it at auction, doing a little flip, then once you refinance that out, you pay your pot of money back to the lender, and you can just tap in and keep going. And a lender gave me an example of a client who did this back in 2008, and they just mopped up at all the auctions using an existing portfolio that they had to leverage to go and buy properties that were being repossessed, cheap things, anything, and they were just cleaning
because
up.
they can literally, with that, you could literally complete in a matter of days.
Yeah, exactly. The funds are there for you to draw down. Yeah, within a day or two. I've just done one for a client now.
Yeah, and these are to be like differentiated from the old traditional credit lines back in the day. That you'd go into your bank. This is like pre-credit crunch. Go into your bank and you're a developer, and they give you a £500,000 credit line that you can dip in and out of. Now, what they would have to do is they would still, because they're going to be secured against the property that you're buying, they still might want to do evaluation. You still want to know about the property you're buying, all this kind of stuff.
Yeah.
If you're doing this revolving credit line that we're talking about, it's a new product where it's secured against an existing portfolio.
Stuff, yeah.
Therefore, what it actually means is that you don't need to do all that due diligence on a new project, because it doesn't matter, because it's secured against a different property.
Yeah.
So that's what makes this such a great product.
Yeah, but I think if you're using that type of product, I think you need a real, you need your blinkers on, and you need to be focused and zoned in on how you're going to grow quickly to make use of that.
Yeah. I think one of the best uses for a revolving credit line is property trading, where you might see, so I've got a client where what they will do is they will spot properties that are maybe in the wrong auction. So it might be a commercial property in a predominantly residential auction, or vice versa. They would go in, they've got the credit to just be able to go bang. They might even go pre-auction, like, I'll buy that, it's guide price is 100 grand, right, I'll give you 80 grand now for it, happy days, great. And then what they do is they just go and put it in the right auction, and they'll sell it for 150.
Yeah.
And then they pay back the money, and then they've got that, and that's like a within a month type transaction. And that, if you can get that right, I mean, it takes an incredible amount of due diligence, knowledge, understanding of the market, experience, having the good people around you, but that is a really good example of how you could use a revolving credit line to make money quickly in property, just
Yeah.
trade up properties.
Yeah, that's it.
Now.
You've got your sourcing and how you get into property with no money, rent to rent, sourcing and things like that. But yeah, leveraging existing properties as like you said, trading. It's good.
It's a good one.
It's a good one.
Cool. Well, look, that is the 5 top bridging finance questions that are being asked on Google right now. If you do want to get in touch with either myself or Shanelle, there'll be links to either get in touch with us directly or book a time in our diary to have a consultation in the show notes / description. But all's really left to say is thanks for watching and
Thank you.
see you later.
See ya.